Cryptocurrency has quickly risen to become a dominant force in the financial world, attracting millions of investors and sparking debates about its long-term viability. While many view crypto as the future of finance, a growing concern is whether cryptocurrencies could ultimately be the cause of a global economic crash. Given their volatility, unregulated nature, and their increasing intersection with traditional financial systems, there are several reasons to question whether these digital assets could trigger a financial collapse. In this video, we will explore how cryptocurrencies could lead to such a crisis, examining specific examples from major digital currencies, and how investors might protect themselves in the event of a crash. The first major risk associated with cryptocurrencies is their lack of regulation. Unlike traditional financial markets, which are heavily regulated by government bodies and international agencies, the crypto space remains largely unregulated. While this lack of oversight has been a major draw for some investors, it also creates significant risks. Bitcoin is the largest and most well-known cryptocurrency, often heralded as digital gold for its potential to hedge against inflation and store value. However, Bitcoin's extreme volatility could lead to a major systemic risk. Bitcoin's price has fluctuated wildly, experiencing gains of over 1,000% in some years, but also dramatic crashes. Consider the 2018 Bitcoin crash. After reaching an all-time high of nearly $20,000 in December 2017, Bitcoin's price plummeted to around $3,200 by December 2018. This price volatility poses a serious risk to investors, particularly when Bitcoin is increasingly being used as collateral for loans. Should Bitcoin's price collapse again, it could trigger mass liquidations, cascading through financial institutions that have exposure to crypto assets. Ethereum, the second largest cryptocurrency by market capitalization, is unique because it powers smart contracts, self-executing contracts with the terms of the agreement directly written into code. While Ethereum has revolutionized decentralized finance, DeFi, applications, it also poses serious risks. If an error in Ethereum's code leads to a failure in a large-scale DeFi project, it could wipe out billions of dollars in value overnight. For instance, the DAO hack in 2016 was one of Ethereum's most significant security breaches, resulting in the theft of $50 million worth of Ethereum. Though Ethereum recovered from this attack by rolling back the blockchain, the incident demonstrated the risks of smart contracts and the lack of auditability and security for many projects built on the Ethereum blockchain. Stablecoins are another major area of concern for a potential global economic crash. While they are designed to maintain a stable value, typically by being pegged to a fiat currency such as the US dollar, their underlying mechanisms can create significant risks. Stablecoins like Tether or USDT and USD Coin or USDC are not backed by physical assets, but rather their value is supposed to be supported by reserves. However, the transparency of these reserves has been frequently questioned. Tether, for instance, has faced multiple investigations over whether it actually holds the amount of fiat reserves it claims. If investors lose faith in the reserve backing of stablecoins, it could cause a massive sell-off. Given the interconnectedness of stablecoins with platforms like decentralized finance or DeFi and centralized exchanges, this could result in a domino effect of collapses throughout the crypto markets. Another concerning aspect of the cryptocurrency market is the prevalence of pump-and-dump schemes, where groups of individuals or influencers artificially inflate the price of a cryptocurrency before selling off their holdings at a profit. This can create massive market distortions, and if a large-scale crash were to occur after a pump, it could have disastrous consequences. For instance, in 2017, the price of BitConnect, a now-defunct altcoin, was pumped by coordinated efforts and reached a peak of $463. However, it collapsed soon after, losing almost 100% of its value, causing a wave of losses for investors. These types of schemes are common in the altcoin market, where many coins are artificially inflated for short-term profit. If large altcoins experience a similar crash due to mass sell-offs, it could cause a chain reaction in the markets, pushing investors to panic and sell off their positions in more stable cryptocurrencies like Bitcoin and Ethereum. This could lead to a global liquidity crisis and an overall loss of confidence in digital currencies. Another aspect of Bitcoin that could contribute to a global economic crash is the environmental impact of Bitcoin mining. Bitcoin mining requires enormous amounts of electricity, as miners solve complex cryptographic puzzles to validate transactions and secure the network. As of 2021, Bitcoin's annual electricity consumption was estimated to be higher than that of countries like Argentina and the Netherlands. The growing environmental footprint of Bitcoin has raised concerns not only among environmentalists, but also among governments. Some nations may decide to regulate or ban Bitcoin mining altogether in response to environmental concerns. If major Bitcoin mining hubs in countries like China, the United States, or Kazakhstan were forced to shut down, it could lead to a halt in Bitcoin transactions, destabilizing its market and leading to a loss of confidence among investors. In the event that cryptocurrency triggers a global financial collapse, it's crucial to consider how individuals and societies could survive such a crisis. Unlike traditional financial systems, crypto does not have a centralized authority like governments or central banks to step in and provide relief. However, there are strategies that individuals could adopt to protect their wealth and ensure their survival during an economic collapse. First, diversifying investments. If cryptocurrencies crash, it's likely that traditional financial assets like stocks, bonds, and precious metals, for example gold, will be sought after as safer investments. Diversification is key to protecting your wealth. As a crypto investor, there are specific strategies you can use to safeguard your investments in an uncertain market. Here are some tips. First, research and due diligence. It's vital to conduct thorough research before investing in any cryptocurrency. Avoid jumping into altcoins based on hype or social media trends. Ensure the project has a legitimate team, a use case, and long-term goals. Second, diversify within crypto. While Bitcoin and Ethereum are relatively safer bets compared to obscure altcoins, it's still important to diversify within your crypto holdings. Spread your investments across several top-tier cryptocurrencies to minimize exposure to the risks associated with a single asset. Lastly, use secure storage methods. Cryptocurrencies, while offering revolutionary opportunities, also come with serious risks. Their volatility, lack of regulation, and potential for market manipulation make them vulnerable to causing a global economic crash. Bitcoin, Ethereum, and other altcoins could potentially destabilize the financial system if their collapse triggers a systemic risk or financial contagion. However, by diversifying investments, securing cash reserves, and practicing proper risk management, individuals can survive and potentially thrive during a crisis. As the cryptocurrency space continues to evolve, it's important to stay informed and understand the risks involved. While cryptocurrencies could be the future of finance, they could also play a major role in shaping a financial crisis. Are you ready for what comes next?